welcome to the special series called Global Mantra, the show that gets you views from prominent fund managers from the City of London. Joining me on the show right now is the head of investments of Hermes Fund Managers, a fund management that manages about £21 billion. Sakar Nosebe is right here with us. Sakar, it's great to have you on the show. Thanks very much for taking up the time.
Well, thank you very much for having me with you.
And incidentally, this is your first interview to an Indian business channel?
Absolutely, my first interview with an Indian business channel.
Well, great to have you then. Okay, Sakar, let me just begin by asking you about your outlook on the markets for 2012. As I read more about what you've written, it appears that you're more concerned about the financial system as is today than it was in 2008. Why is that? What is the specific concern out there, and when do you think things will kind of show up?
Let me first differentiate between the market and the system. The market might rally simply because people have been too bearish and have oversold. The systemic problem has not been solved. The systemic problem is that the credit bubble that led to the crisis of 2008 needed an injection of capital to help the banks survive. That was provided by world governments. The result of that is that world governments find their own finances very stretched, and we have not yet heard a credible plan of how to pay down that debt. That's the first issue. The Americans seem to believe, and there's some point to that, that if they generate enough growth, then the increase in tax revenue might do the trick. The British believe that it's a combination primarily of cutting costs, meaning trying to spend less money, and some growth. But the issue is the Europeans haven't quite worked out what it is they want to do. And until we think of a way of repairing the finances of governments, we're not really out of this problem. And that is my concern.
Do you think the political powerhouse actually understands the problem as is? Do you think the governments in the eurozone can actually get together and solve this problem? Because from what you're saying, there are too many questions out there, but few answers.
I think that's a very good question. I think, again, you have to divide between almost three segments in Europe. I think that as far as the regulatory framework is concerned, and that's separate but does have an impact, it's not coordinated. By that I mean that the regulators in various aspects of the financial industry are behaving perfectly rationally, but if you combine their activities together, it's, you can argue, irrational. The governments itself, I think, probably understand that the answer is not an economic answer. The answer is a political answer. The issue is you do have sovereign states that have to, as an only solution, give up some of their sovereignty. I don't think that economically people are not clear what the answer should be. I think it's politically they're not clear what the answer should be. And the answer, there are two answers, like everything, but the answer must involve some reduction in sovereignty for the periphery countries and maybe even for all European countries. So the question is political. Does Mr. Sarkozy and Ms. Merkel, do they understand that there'll be some kind of closer fiscal ties and probably some giving up of sovereignty by, say, the French Parliament? Yes, they do. Can they swing it by their parliaments? I'm not sure, and that's the question.
How much of the fear do you think of this uncertainty is priced into the market?
I think you're absolutely right. I mean, I think about a year ago, people were not that bearish, and we've seen the decline in markets as the news flow came through. At this stage, you would say that people want to see a reason why the market should go up, and they're looking for good news and not bad news. And you can see this reflected in share prices around the world. People want to see a reason to rally. And there might be, but you could have a rally and still not solve the underlying problem, and therefore the rally proves to be simply a mirage. And it's not going to be the same across the world. It will differ from one part to the other. I think that, as I say, probably the element that might surprise on the upside is the United States. And that does have ramifications because that will have a positive impact on Europe. So if the United States begin to see a healing of the economy and the beginnings of growth, and we see that reflected in asset prices in the United States, that will give a feeling of confidence around the world. That will have an impact on Europe that trades with the United States. That will have, importantly, an impact on emerging markets, which have seen a decline, and, in fact, on commodity prices. So, bizarrely enough, if we can begin to see the engine begin to work there, it will help everybody through.
Talking about the fixed income market, since you mentioned that, you had spoken about how European regulators are really trying to manage the risk that pension funds take, by actually inducing them to purchase or increase their exposure to the fixed income markets, to increase their exposure to government bonds, and thereby reduce the kind of money that's going into, or reduce the risk that they're taking on equity markets. In that sense, given the kind of demand that we've seen for sovereign debt in Europe, Do you believe that there's a fixed income bubble in the making, not just in Europe, but also in the US?
I mean, I think the answer to that must be yes, simply because if you look at the yields at present, you look at the history against 250 years of yield history, and you come to the conclusion that from here on, yields must go up. I mean, it's just inevitable. If that happens, then capital values must come down. Whether it happens this year or next year doesn't matter. It is an inevitability. You mentioned the regulator, and I'd say the regulator, I would argue, is mistaken on two counts. The first count is the move that they're forcing through Solvency II and the move that they're trying to push the pension schemes into going into fixed income assets is based on the premise that it's less volatile, less risky. That is only true if you believe that fixed sovereign debt is not volatile and is risk-free. If you happen to live in Italy or in Greece, I would argue that argument does not stand. And then you start arguing, well, it doesn't stand in Greece and Italy and Spain, but maybe it stands in the UK and in France. Maybe, but then it's arguing about not the theory, but its application. The second reason it's flawed is that they forget that the asset management industry is simply a pipe. It's a pipe that takes the savings of a nation and converts it into risk capital that's invested for the growth of the nation in future. And if you starve the corporate sector of the investment through the stock market, how are you going to guarantee the future growth? And it's not such a silly thing to ask, because going to emerging markets in China, the Chinese authorities recently have gone exactly the other way, where they're trying to force their own pension schemes and insurance companies to invest in the market. Now, they're not doing it because they're silly and they don't understand how markets work and they're trying to manipulate the market up. They're doing it because they want to redirect some risk capital from a pool of savings that is not linked to the future growth of the market to a pool of savings that then puts it to work in the corporate side of the market.
So does that mean that there has been on an average a reallocation in pension AUMs across the European region where money is actually being withdrawn from emerging market equities and developed market equities to put in fixed income?
Undoubtedly. I mean, you can see this trend in the United Kingdom where the de-risking move is well underway and well entrenched. You can see that beginning to happen in Europe where insurance companies, who are the big investors, because of Solvency II, are beginning to prepare themselves and de-risk. And all that means that they take the money out of what is traditionally viewed as risk assets, which are equities, what are out of what is traditionally seen as the more risky part of equities, which is emerging markets, and putting them in sovereign debt. My argument is actually that it does not reduce risk. That's the first one. And secondly, it doesn't answer the long-term question, particularly about developed markets, is how do you then finance the future growth that in 10, 15 years' time will allow these economies to grow?
So what is your investment philosophy right now, for 2012? How are you looking at the money that you manage?
I would say that you have to reassess what risk is, and as I mentioned at the beginning, I think there is an opportunity in asset classes that have been forgotten, and where people have said that equities are a boring investment, particularly large cap and small cap equities are much, much more attractive. I would say, well, maybe, but if I can buy into large companies that are exposed to emerging markets, I get emerging market growth. If these companies pay me a dividend, then I'm getting a coupon and I'm getting a yield. And if these companies can move their prices up with inflation, then I'm getting an inflation hedge. So I get a kind of index-linked instrument that pays me a dividend. That is an attractive aspect. It also allows me, if I'm not an expert, to be able to get exposure to emerging markets without having to go into these markets directly. I also would look at debt, and I would say that corporate debt in certain parts must be very attractive because corporate companies are very strong. And I would look selectively at emerging markets, and I'd say parts of the emerging markets might be attractive from here on. And there's, as I say, the halo effect that happens, that if you see a pickup in the US economy, that begins to translate into a pickup in particularly the Chinese economy, but then eventually into the Indian economy and also, of course, into the European economy.